All right, so we've got some things to talk about after this week. It was more warning signs, more yellow flags, red flags, kind of bearish sell signals. There are concerns out there. There are cracks. It has been kind of edging that way over the past week and a half, really 2 weeks. We've been getting more kind of, neutral, selective, still had a bullish bias, have a less of a bullish bias looking ahead this week, but there's two big catalysts that could really sort of put a floor in this market and change the sort of prevailing trajectory. So we're going to talk about that. And despite my bearishness out the gate here, I did buy a couple of things this week, and we're going to talk about that as we move along. So let's get into it here. We got to start with Intel. This is now the next kind of soldier to sort of fall here after blockbuster numbers. And this is what is concerning right now, is when you go through kind of the social sphere or the analyst sphere, we are hearing, wow, the numbers are so good, but the numbers, they're so good. And as a trader, the worst thing you want to see is a market go down on good news. To me, that's not a comforting thing from a short to intermediate term trader perspective. I get that the investor audience is excited because there's probably a lot of runway in the secular sort of trend here. But in the short to medium term, the market is sending and has been sending a very clear message. We have basically sold off all of the stocks that are reporting these blockbuster numbers. So Intel, while still pretty innocent, is still kind of moving lower, wasn't good enough. And that is a very important message here as we look ahead. Google, Alphabet, I mean, again, the numbers were very strong, but the market seemingly getting a little bit concerned and nervous about the increased sort of Capex going into next year. And so I think there's kind of a shoot first, ask questions later. And, when you look at Alphabet here, it's actually not that far off from that April gap up. So if you recall earlier in the year, when we kind of came out of sort of the Iran war first phase of ceasefiring, we had this vicious kind of move up here in lots of stocks that created these big open runaway gaps. And we're very quickly kind of coming back to that zone here in Alphabet. I suspect we'll see that filled in the next week or two. Tesla breaking multi-year kind of trend line here. This one's probably a little bit different because I think fairly objectively, the report was not so good. They did sell a lot of cars, but they sacrificed their gross margins and they're spending a lot. I mean, I think it's good that they are spending so aggressively. They are obviously shooting for a very big TAM in the future, but the market really sort of had enough of it, I suppose, and didn't want to wait because this is a hell of a weekly breakdown here and a very large move down. This is the 2-day move here. So basically really sort of punishing the stock, breaking down, breaking the April lows and making new cycle lows here, probably 52-week lows for Tesla. Mag 7. So when you put this in the mix here as well, something happened to my chart because I think this should be, actually no, that's it. That is correct. Don't mind all my scribbles. This was the biggest down move here for the past year for the MAGS ETF. So this was on the heels of Tesla and Alphabet reporting the same day. We saw just a lot of wind come out of the Mag 7 sales. Now, with all of this going on, we also have the 10-year Treasury yield, which is getting pretty jumpy here as it moves to new kind of 52-week highs. Again, not quite the backdrop you want to see. Inflation expectations are going higher. And next week is the Fed, and the Fed is meeting, and there is a very real chance that the Fed is going to be raising interest rates next Wednesday. And so there's currently priced in about a 35-36% chance of a rate increase next week. Now, this is where the silver lining kind of happens, because this is going to be a volatile day when you see these kind of odds. When the market is this split, even though we are favoring that they're going to keep things steady, there's still ambiguity being priced here, and there's positioning that is going to be shuffled around pretty significantly on this Wednesday, unless we get some rhetoric ahead of time where the odds start to really shift. But there's uncertainty clearly getting priced here, so you have to expect that this is going to be a volatile day here. And it also creates opportunity, though, because if we are selling off into this event, if there's fear coming into it, if people are hedging the event and we don't get a rate increase and we get a softness of rhetoric, and maybe some of the other Mag 7 reports calm the market, these are the two things that could create some type of V-shape in this market. That's what could change the trajectory of the current kind of bearish leaning slide that we're currently seeing. I don't know how to assign probabilities to those, so you'd have to do some homework and thinking on that. But that's the bullish optimistic coin flip on how we get out of here. Is I think a positive event here out of the Fed and earnings that actually meet expectations or don't get more bad, let's call it. So that's the optimistic note. Now, earlier this week, I put out this video here called Careful Chasing. This is where, I pretty clearly saw the kind of deteriorating factors here early in the week. So I put out a little midweek video that just said, hey, some of these stocks are bouncing. Some of the high flyers are bouncing. Be careful getting excited. We did see most of them roll over into the end of the week. It's a tricky market out there. And I think dip buyers have been very comfortable. They're confident. Those are dangerous things. Now, to sum it all up, Friday, we get a downgrade here in our market health score. This is the first time since earlier in the year, prior to April, March, when we were in the bearish swing trading state. So our outlook here from a swing trader perspective is we are in the bearish environment. For us, for me, for our process, which I will walk you through a little bit more at the end of this video, we will still take signals. We will still take some longs, but it's almost like minimum 50% cash on hand, hopefully even more than that. High A+ quality setups. Like it's pretty much those two things. But this is the dangerous swing environment where you don't want to flippantly be out there just buying dips. If you're a trader, again, investors, different conversation. Now, before we get into the numbers, our sponsor, IBD, Investors Business Daily. They've been sponsoring our content for a while. They're great folks over there. They build great products. Check out these links in the description of this episode once you get done finished. So let's run through some numbers here, and then we're going to get into some charts. Oil, we didn't even talk about Iran, but obviously, I mean, it was neck and neck with kind of the 10-year Treasury yield going up, inflation expectations going up, oil going up, gold also up, everything else down on the week. S&P 500, I mean, you got to give it credit though, still hanging in there. I mean, it looks like a mess in this choppy range, which is what we've been warning about mostly these past few videos, is don't get chopped up, be careful, don't overtrade, don't get chopped up. It's very easy to, but the market's still kind of hanging in there. VIX 18. So, there's been a lot of conversation of, well, doesn't seem to be that much fear out there. The VIX is only at 18. I would point you to a couple of things. One, the Nasdaq volatility, which I just don't have here, is higher. It's in the 20s. And single stock volatility is very high right now. There is clear dispersion. Indexes are, kind of being pressed down a little bit, but there's lots of movement under the hood. Look no further than Tesla and some of these other stocks, some of the high flyers, the infrastructure names. I mean, they are 40% off of the highs. So there are extreme moves happening underneath the hood. But then you have something like Apple, which is trading like it's just enjoying a nice Sun Harbor cruise, just floating to all-time highs. There's not a concern in the horizon. And that's why we've got lots of kind of turbulence underneath the hood. VIX doesn't tell the whole story. Dollar index, jumpy, moving back up towards highs. 10-year Treasury yield, we already talked about it, breaking out to new highs. Sector performance, there were a lot of winners, surprisingly, but mostly defensive. So energy, utilities, healthcare, real estate still doing decent. and, technology or discretionary tech communication services hit hard. 52-week highs and lows. This is not a great look here. You're getting a spike in the number of stocks hitting 52-week lows. So that's not the ratio we want to see. Meanwhile, you've got the number of stocks hitting 52-week highs drying up. Percentage of stocks above a 20 SMA also sliding lower. That's not good. Put to call ratio, again, not that defensive or panicky. Granted, this is as of Thursday's data. Next week, we've got, of course, I think just the big elephant is the Fed. So Wednesday, that's the Fed interest rate decision, which is a live meeting, which means we could get a hold or we could get that hike. So that's it for part one here. Let's look at some charts. All right, so here we go. We've got some charts in front of us. TC 2000, S&P 500. Look, it's still sandwiched in this range. This is the one thing that we've been very clear kind of harping on is you've got this big band of support down here around 7250. You've got this big band of resistance above 7600, and it's chop, chop, chop summertime. So we're right in the middle of it. This is a frustrating part for traders and for people who want immediate kind of moves and trends. So I don't have too much else to say about it except for we're in the middle of it and expect more of it. Nasdaq 100, slightly different story here because we've got a problem. We're dropping below this lower band right now. And so we are not holding into this range. We are in fact kind of rolling over. We did fill a gap back here, but the Nasdaq 100 is clearly heavy. This is the more troublesome spot here for the indexes. Russell 2000, kind of just this grinding sideways lower drift that's kind of going on here. It acts a little bit differently than the big heavyweight indexes. It has for the last year or two, frankly, or longer. Don't have a whole lot to say about it beyond that. Semis, very important index right now. And this was surprisingly resilient this week. It was up this week. Didn't feel like it was up, but it closed up. And again, we should be thankful that it was up because if you had the Mag 7 rolling over and the Qs, this is really what was kind of trying to keep things up. You had semis and I mean, I'll just call out Apple again. You had Apple. This was up 3.5% on Friday. Apple was flat on the week, but it certainly recovered a lot of its losses, and it looks structurally just in a totally different league than pretty much everything else right now. So that's dispersion. That is the market kind of picking a little bit of a winner here. Apple reports next week, clearly, I guess, being rewarded for not spending all their cash and yada, yada, yada. So that is kind of the main movers there. Semis, though, are definitely important. You can see what everybody's looking at is like this potential head and shoulders kind of topping pattern. I'll believe it when I see it. I'm not willing to say that semis are just done and we're about to roll over from this pattern and come back here and fill the April lows. It could just be a big continuation pattern. But it certainly needs time. And, the volume here just doesn't look great. It's just a handful of distribution days. All the heavy dollar volume traded days are on down sessions. So, let's see how we progress here in semis. It was a win that they were still up, showing relative strength 1% on the week. I think that's very clear. Now, again, to go back to our work and research, we built a product called Market Navigator. It's made for swing traders. If you're a swing trader, it's a pretty nominal cheap fee here, and its accuracy and its headache, it's helping you not get headaches all the time is in my opinion pretty high impact or pretty helpful. I don't know where that analogy went, but weak swing environment. This is the problem now. So again, we were bullish, all coming out of the April lows. We went neutral, mixed coming into July. And now we are flipping to the bear side. Again, it doesn't mean that we have to have a big bear market here. It just can simply mean that the conditions for swing trading are not good. They're not worth the overnight risk and the heartburn. It doesn't mean that we have to go down and have a 20% correction in the Nasdaq 100. That's not what this indicator is telling us. So keep that in mind. Conditions here have certainly weakened up. Our stance on that is basically raise cash, get a lot more selective, and you need A+ quality setups because you will eventually get stocks. The leading stocks for the next cycle will, by definition, start to act better and kind of lead us out of this. So you can be on the lookout for them, but it's reducing size. It's all the responsible things that I think we all ought to be doing right now. Bearish internals also have happened. If we look at our Mag 7 outlook now, so we are now moving back. So it's been a little bit of a whipsaw here. We started the month getting buy signals, and now we're seeing Meta, we're seeing Amazon, we're seeing rollovers here. And now we've got a very split race between basically Apple, Nvidia is still holding up, and believe it or not, Microsoft is holding up. But that certainly, you know, had its different cadence in its sell-off. Mag 7 report earnings next week, or pretty much the bulk of these over the next 10 days or so. So this is going to be pretty telling. Again, I think if you can survive the Mag 7 and maybe you don't get a hawkish Fed, maybe this market rips out of here and we are, you know, only in the bear state or the bearish weak swing state for a week or two. That'd be a very great scenario. For now, I'm still planning on this being the predominant sort of message of the market right now. All right. So let's look at what else was doing well this week. So I've been keying off of Biotech. You've heard me talk about Biotech as being kind of the place where you can still look for setups. I still think that to be true. XBI was hit this week, but structurally, I still like the potential there. If you want to go even more conservative, then it's just healthcare. It's XLV. And again, XLV was more of the defensive this week. It's up 1%, and you can see it's trading just near its highs. So biotech, healthcare, I still like the general space over there. We talked about VIX, we talked about semis, we talked about Apple. Some of the beaten up names in the AI kind of infrastructure play or space. Oracle hitting new 52-week lows, down 9% this week. Again, I think you're just going to have a lot of trouble. You're creating so many more bag holders here. Value for investors, maybe. You know, if your time horizon's long enough, then yeah, and you believe in, you know, the handful of things that need to happen. Same thing with CoreWeave. Like, can there be value for investors? Yes. For swing traders, you got to be quick. You got to be, you know, looking for quick bounces. SpaceX, again, these are all just stocks that are getting pummeled right now that, you know, certainly have value, but they are selling off at this point in the cycle. I don't know how else to square it. You just have to be careful here, know what you own, know the position sizing, and all that fun stuff. Now, I said I would leave you with a couple of names that we bought this week. So what we launched this week was finally a decisive rockets portfolio. All right. So I'm going to take a minute here. Our rockets, so let me go back to the homepage of our website. I don't know why data is being a little tricky today, so I apologize. Probably, there it is. Okay, apologies. So let me zoom in here. Our Quant rockets momentum universe. So what we do is we basically start from all 6,000-ish stocks that we look at every single day. We're ranking, we're evaluating, we're applying a handful of screens, criteria, cross checks, looking back over decades of data. And what we do is we distill it down to a universe. So there's 128 qualified names in our universe that meet volume or liquidity, range, momentum. And then we distill it down to our rocket signals list. And that's what we've always had throughout this past year is our momentum signals list. This week, we launched our portfolio, which is a concentrated group, which we will have, you know, anywhere probably on average 8 names in it, but you could have up to 15. And this is the real sort of top ranked, best in class momentum stocks, all managed with portfolio rules, position sizing, the whole 9 yards. I think it's a pretty amazing portfolio. I'm certainly allocating and have my funds there, but let me walk you through if my data loads. So usually your experience should be better than this, but as we go through here, we picked up 2 names towards the end of the week, and I'll give you a freebie here on Monday of what we're buying. So DELL and HPE, those were the 2 buys on Friday for us. HPE Hewlett Packard, kind of an old legacy name, right? But obviously up 100% this year, just about. And beautiful run up here. Not many people talking about it. Great move. Extended, yes. High upper level base. We've got our stops in place. We own it. Its close cousin in a very similar same space is DELL. DELL had obviously a huge move. It has been consolidating for the past month and a half, and we came in here and we purchased DELL. Both have stop losses, both have position sizes, we have profit targets, and we're monitoring the health of the market, which also could help us get out of those positions. We've got one for next Monday, so I'll give this one to you. This is one we don't own yet, but we will be buying, and that is Hut 8. So again, zoom out here. You can see a stock that just looks a lot better than most others. Relative strength is better, up 100% on the year. Decent volume pattern, drove off the lows, maybe not out of the woods yet, might need more time consolidating, but that's fine. We can, pay to be patient or find to be patient. And those are the three names in the portfolio, 70% cash. So 70% cash. Couple of names that are concentrated that we're picking off that we think are A+ high ranked quality setups based on all the factors we look for. That is the way we are driving this brand new Rockets portfolio. So we're talking more about that. We've got our big signals list. We've got our universe of names. I'll bring you different ideas on the different parts of the week, but we'll see how things progress. I think the message though this week is be careful out there in this choppy environment. This week's going to be very volatile with all the earnings and the Fed. So just take note of that. If you're a new trader, dial it back, step back, reduce the position size, sit on your hands, watch the fireworks. If you're more advanced, then of course you've got volatility and you've got opportunity. You just have to know kind of, where you live as a trader. So that's it for me. Thanks as always. We got links in the description for our trading systems, our sponsor IBD. Don't forget to subscribe if you like the content. Thanks so much. Enjoy the weekend. We'll see you back here next week. Take care.